All right, so let's step away from that. Still on the idea of a fear of a bearish market or considering protection on stocks that you own, Lance sent us a question regarding in-the-money married puts. And Lance says to me, Mike, when doing married put searches using the search by symbol tool, it's one of the tools in Power Options, not the main search where you can set your criteria, but just looking up positions and strategy by symbol. I see a lot of suggestions where the put is higher than the current market price, meaning the puts are in the money. Should these be considered, and if so, under what circumstances? Is RadioActive Trade or something else? Okay, so the answer to that, I answered all three, Lance, Luca, and Todd individually via email. But the answer to that is I trade the radioactive techniques using the in-the-money married put structure. So I'm always going to advocate that. If you're looking for long-term protection, bullish outlook on the market, you're going to be trading stock positions, I'm always going to recommend the in-the-money put following the rules in the blueprint, the full product that discusses our approach to controlling risk properly and the 12 income methods that we use against it to further reduce the risk and potentially bulletproof the trade, meaning canceling all of the risk. I'm going to go 1 to 2 strikes in the money. I'm going to go less than 20%, and I'm going to target a risk somewhere between probably 3.5 to about 7.5%. Remember, Apple was at 226.90 or somewhere along those lines, 226.92. I didn't think I took it on the screenshot here. Let's call it 226.92. Where are the puts that give me the single-digit controlled risk I want? And I'm going out to March again. There's a reason why, because I want to be 6 months out in time to follow the 3 rules of trading, the proper position sizing, number 1, but also the ATM bell curve and the time decay curve. That's a terrible time decay curve. The time decay curve, where options we know that are 14 days out in time decay rapidly, 30 days out in time are rapid, 60 is a little bit slower. 90 starts off slow but gains quickly. 120 is not bad, but if I'm out here at the 150, 180 range, maybe 5 to 8 months, I start off with a very slow time decay, all things considered, before it starts moving against me rapidly. Okay, so that's our target, that's our structure, that's why I'm out to March in this example. But again, the ones that match my target range of 3.5 to about 7.5% are mostly all in the money. The 235 strike at 5.4, that's probably where I'd gravitate towards. But the 230 at 6.3 is not bad either. Low risk of 4.5%. All this risk is the time premium. So yes, I'm paying a higher upfront cost for these positions, but the risk is only the time premium. I'm guaranteed to get this intrinsic back if the stock doesn't move. Okay? And the time value is going to be slow. So in the first 30 days, if this married put with a 230 strike and a 6.3% at risk, if the stock stays right at 226, and 30 days from now we go from 168 days to 138 days out in time, if volatility stays the same and the markets just plug and chug along, I'm probably only losing 40 cents or so on this premium. Maybe 50 cents, that's it. If I bought the 18th of October put, it might only cost me $1.50, right? But if the stock starts to stagnate and does nothing, and I'm at the money 225 and paid $1.50, $1.75 for it, I'm losing close to 20 cents a day, not 30, 40 cents total over that 30-day time period or 14-day time period. Much different. You know that's going to go to zero faster. Okay, so if you're buying stock, Lance, you're interested in a married put, you're interested in holding the stock, whether for dividend or to make adjustments over a long time horizon, it's always better to go slightly in the money, buying further out in time, because you do pay a higher upfront cost, but it's a lower cost per day. That's just the way options work. You never pay 6 times the cost for the option that's 6 months out in time. It's much less. You have a lower annualized cost. If you bought the option, same strike, let's say 230, for October, then November, then December, then January, then February, then March, you'd probably pay 50 times as much as I'm paying right here at 1840. Okay? Well, to see that a little bit in action, let's go forward. Let's go to our next slide. Does this mean you should always use an in-the-money put? Well, no, it depends on the situation. I'm talking about if I'm going to buy a stock even to hope to see a profit in a 60-day time period, I am buying a put that's 5 to 6 months out in time because it's going to decay less rapidly than the shorter term. But if you're concerned about a near-term decline, you already own the stock, you're concerned about a near-term decline, earnings is coming up and you want insurance in case S happens, then it's okay to buy a shorter term put. You just want to structure it based on what your needs are. And if I'm only buying it, let's say earnings are coming up on October 7th. It's not, I didn't look it up, but let's say earnings are coming up on October 7th. I want some short-term protection in case my stock that I'm holding right now does fall 10, 15, or 20%. Sure, I could just buy a simple, 220 for $2, right? It's only adding another 3.9% of risk to my position. If the stock falls to 210, I get $10 back from the put, and I lost $15, so I hedge some of it. Okay? But you see the lower risk values are up in that same range, 230, 227.5, even 225. It offers better protection, but it comes at a cost. Okay? So that's the trade-off. It depends on your situation. If I'm opening a stock that I want to hold, even if my expectations are that in 20 to 30 days it's going to move up 5, 6, or 7%, I personally am still buying the put that's 6 months out in time because I get a lower cost per day. Look at it here. The 230 put, we were just looking at it. It was a price of, was it $18.40, I think, on our last screen? Yeah. So here it's $6 for 14 days versus $18.04. Let me just check that before I start rattling off numbers again. Let me go back one. The 230 was $18.40, right? Okay. But here it's $6. Now, 4 of that is intrinsic, roughly, so the full risk is, that's more than $3 is intrinsic, so the full risk is $301. What does that mean? If the stock stays the same in the next 14 days, I'm going to lose that whole $3 of extrinsic value, the time value. It's going to go to zero. It has to go to zero. I'd keep $3 intrinsic, but I'm going to lose $3 of time premium. Whereas that farther output would likely only lose 30, 40 cents. Paid $18.40 for it, but the time decay is going to be slow, 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 as opposed to this one, which is going to be fast, fast, fast. Okay? You're probably going to lose less because it still has 150 days to go to expiration. Okay? So, but it does depend on the situation and what you're looking to do. Now, if you already have a gain in the stock, you've been trading it for a while, you've been doing it as covered calls, maybe you got it because you sold a naked put, got assigned, it moved back up on yourself, moved back up, I should say. You've got an unrealized gain in the stock. Use the stock insurance tool in Power Options. You can find it under the Married Put tab, the Collar tab, and in the Signature Tools tab. And we're going to take a look at this as well. We just went out to January. What this tool does is you put in your cost basis for the stock. You put in the time frame or expiration that you want, and then it shows you which puts would give you the best locked-in profit. What does a locked-in profit mean? That means guaranteed profit if you bought this put now heading into an earnings, heading into fear of a market correction, or anything along those lines. It's extremely powerful. But what do you see here? What gives us the best locked-in profit? The in-the-money put options, right? These don't give you as good as a locked-in profit even though the price is lower. Why? Because it has to drop first, give you back that extra 5, 10, 15 points before the insurance kicks in, even though it's a lower price. You get the better locked-in profit and risk control up here in the money section. Okay, so with all that being said, very quickly before we get to Todd's question, and then we get to the live questions that have come in. Let's pause the screen real quick. I'm sorry, ladies and gentlemen. We are going to navigate over to Power Options. We're going to take a look at the stock insurance tool in action. Okay. All right, let me change my screen, ladies and gentlemen. Fantastic. And you are now seeing the Power Options screen. This is our webinar trial account, so those of you just getting started on your trial, of course, I want to remind you to take advantage of the 4 steps that are here, the free quick start guide, go through the flash tutorials. You can access our archived webinars here, webinars on using the tools, general options trading, getting started with options, and advanced strategy discussions are all there. Any trial member or subscriber can schedule a free coaching session at any time, essentially 35 to 45-minute phone conversation with myself or Ernie. Pretty much runs just like these webinars. It's not a sales pitch. I'm just going to answer your questions about the site or give you general direction on what you might want to use and how you might navigate to it and what tricks will help you find specifically what you're looking for. But this insurance tool that I mentioned can be accessed in a few places. If I go to the Married Put tab, there's a search by symbol that Lance was talking about. But there's the insurance tool. You can also access it under our signature tools, volatility skew, spread chain, long option finder, and insurance. So again, let's just take Apple, and let's say I have an underlying cost basis of $199. I've been trading it for a few months. I have an unrealized gain I haven't cashed in yet. And I know earnings are coming up, let's say, in 25 days, and I'm also worried about a potential market decline. So maybe I'll go out to November. I'm just going to select my buy put month, and then we'll hit calculate. All right, so it shows me right now that my unrealized profit is 14.1% on my positions, okay? And if I buy the November puts 42 days out for the standard expiration, 28 days out for the first week expiration, November 8th, 35 days out. So it's showing us all, but 42 is the standard expiration, the November 15th cycle. But we see the highest locked-in gain again is where? At the higher strikes, 250. It will cost me $24.58 for that contract, which would put my cost basis at $223.58. I'm increasing my cost, but I have a $250 put, which means I'm guaranteed $26.43. Not the $28 unrealized that I have in now. I'm giving some up. But even if the stock doesn't go above $250 by November expiration, or if it falls back down to $199, I've locked in that profit of 11.8%. That's a bulletproof position. What do I mean by bulletproof? When you have a married put position, where your cost basis for the stock and the put is below the put guarantee price, there's no chance for loss. Yes, in this example, I'm going to need a large move to get advantage of further profits on my cost basis. But if there's an event coming up, I'm worried about a market decline. Here I'm guaranteed to make a profit 11.8%. And if the stock jumps up to 260 or 270, I'm still increasing my profits. Jumps down to 200, 199 to my cost basis, 190 below my cost basis, I'm still making about 12%. Okay? But again, yes, you can pay less for those lower strikes, but you don't lock in as much profit. Yes, I can go cheap. I can go shorter term. We can go into, say, October if I was worried about that 14 or 7-day event. And we can go cheap and let's say buy the 210 put for only 62 cents. That still gives you a bulletproof position in this case of 5.2%, but it's only 14 days of time. If there's no movement in those 14 days, okay, well, you lose the value you paid on the put, but it didn't affect your position much. But then if you're still worried, what are you going to do? Now I'm going to have to pay another 62 cents to buy a 210 put, let's say, to the end of October, October 31st. 14 days away, right? And this already added to my cost basis. Now I'm adding another 62 cents to my cost basis at a price that's 15 points below the current stock price. So the stock has to fall that 15 points before that insurance kicks in. Rather than generating premium, I'm adding to my cost basis each time, waiting for this decline that hasn't happened yet. So that's what you have to consider there, Lance, is when you're looking to buy the put, what consideration do you have as far as the time frame of the decline, the amount of the decline, and more? All right. Okay, so I do have two questions that came in related to things that we've looked at just in a moment, but we're going to actually go through Todd's discussion first. But this applies to everyone. If you have stock, you know we're coming into an earnings season, as was mentioned with the question coming up next, and you want to try to lock in some of that profit. Just go to the insurance tool here under the signature tools or under the married put tab or the long collar tab, put in your stock, put in your cost per share, select your target month, and it'll show you which positions will give you the best locked-in profit going forward through the event that may cause the stock to fall. All right. Now, back over to our slides, ladies and gentlemen. And good. So this goes back to Todd's question, why I tied the two together. Todd said, given we're heading into an earnings season, what are your thoughts on purchasing a short-term at or in-the-money call option, 30 days or less, on a stock that has earnings coming up? If the earnings are positive, I can then exercise the option and convert it into a married put for further growth with maybe a locked-in profit, a bulletproof position, or a very low risk. Now, what he means by this is that when I open a married put, I make sure that that risk, that monetary risk we were looking at, whether it's 5%, 4%, or 3%, let's say it's $300, but that monetary risk doesn't represent more than 1 to 2% of my total portfolio. That helps me dictate, am I buying 100 shares and 1 put, or 200 shares and 2 puts, or 3 and 3? Okay, so he says if we're following the same proper structure, meaning if that position sizing dictates he should only be buying 200 shares and 2 puts, he would only buy 2 calls. So if I can only afford 100 shares, I'd only purchase 1 call option to keep the risk low if he's wrong. Now, although I didn't get slides together directly, we are going to take a look at this briefly. And my answer to him via email was, although this is still controlling risk properly by just doing the 1 call and leaving the cash aside that you would use to buy the stock if you decide to exercise it. Okay? But leaving that aside and keeping the cash, the unexpected can still haunt you in this structure. And what do I mean by that? What did we just see in the discussion of buying the shorter term put versus the longer term put? Or earlier, when we talked about buying an in-the-money put with a high delta expecting the stock to fall, doing shorter term versus longer term. You know that shorter term option, if the stock doesn't go in the direction you expect, is going to go to zero rapidly. It's going to go to zero very quickly. So this has the potential, of course, even a 30-day out call to see that rapid decay and suddenly have a 100% loss. Now, you're using the proper position sizing. I understand that. But if I like the stock, even though it has earnings coming up in 5 days, 10 days, or 14 days, I still might open it as a straight married put, because if I open it as a married put and the stock collapsed, that put still has value because it was 180 days out in time. I can manipulate the profit in the put via the income methods talked about in the blueprint to actually lower my cost basis with the decline. And if I think the stock's going to recover, it's almost like averaging down, but I'm getting paid to do it. I didn't put more money in. I'm taking money out. Right? That's one of the income methods. I could also adjust the position if I expected for further declines by taking the profit off the put that I had in this time when it went against me. It dropped. It didn't go up as I expected. It had a big drop, and reposition the trade to profit in both directions if it does recover back up or if it continues down. If I'm just using the long call, even though I'm using proper position sizing, if that stock falls unexpectedly, I have the full loss. I can't really manage it with anything because I can't get anything back. It's at 2 cents, 1 cent, 3 cents. The loss in your portfolio was controlled by the position sizing, but you've hit the full loss that you would have in a married put in 14, 15 days. And then what do? Do you buy another call on earnings coming up, and that has a decline, and now you've lost 2 full 2% trades on your portfolio in 30 days, as opposed to if you just opened the married put, it probably would have only been at a 0.7 or 0.8% loss because it still has 150 days to go. An example of this would be Alta. It's cheating. But I'm okay with cheating sometimes to prove my point. I didn't get these entered into the portfolio. However, what we're going to take a look at here is, those of you that don't know what I'm talking about, is Alta Beauty, currently at 256. But on August 27th, we're going to take a look at the historical chains here. On August 27th and leading up to August 27th, stock was at 323. It had dropped a little bit that day, but then the next day, on the 28th, it was back up to almost 340, I believe. It was trading around 335, 336. Oh, sorry, it's just at 330. All right, so it's at 330.38. Now, I could go out and I could say, hey, let me buy in October. That's 30 days out, right? It was 51 days out, pretty far. I could buy the October in the money call, at the money call. Let's just take at the money, the 330 call at this time for about $20 per contract. Okay, well, what's going to happen the next day? Well, Alta's been going up, up, up. Great trend, great trend, great trend. Earnings are coming out night of the 28th. I'm sorry. All right, August 29th, it's still up. Okay, 337. So we paid $20 yesterday for that October series, that October 18th series. Sorry. And you can see here, I'm sorry, it's like $21 or so. But let's go to the next date. August 30th. Sorry, got my days wrong. So on August 30th, what happened in this case? Well, 30% decline, 100 points. Alta goes down to 237 from the earnings. My October 18th 330 call is not even on the map, but you could see the 305 is at 25 cents. Okay, now you would have only done one contract, put in $2,000. It would have represented somewhere between 1 to 2% of your total portfolio, or two contracts depending on your portfolio size and what you're willing to risk. But that's to zero now. Is the married put at the full loss? Most likely. But remember, on August 30th, or August 29th, I probably would have bought, following the technique, January, possibly in March if available. I probably would have gone to March. And I likely would have purchased at 337. I'd probably say the 350 put. Now, yes, I'm paying $40, but $13 to $14 of that is intrinsic value. So let's call it $27 monetary risk for the 350 put for March. And then the stock falls. We paid a higher premium. I understand. We added to our cost base. We got a ton of money in it for 100 shares. But with that 30% decline, got to go to the large chain now. $350, $350, $350. It's at about $112.50. Okay, so it's still pretty close to the same loss, but what could I do with that now? I could sell this put, take the $72, $73 in profit I have, even though I lost 99 on the stock, and I could restructure the trade. Take that profit off the table, stay in the position. Now, would it have worked? I don't know. That was a huge decline, and I haven't checked it since then. Let's go to big charts. Yeah, see, it started to come back up. So what I could have done is reposition the married put, taking my profit on the position, doing this way, and as the stock now started to move back up to 270, I could have done a couple of income methods here to cancel that risk further from where I restructured it, but I could have lowered my cost base on the stock down to probably 270 by manipulating that put option. I don't have that ability with a call. I just have to let it go to zero. Then if I think it's going to come back up, I got to buy a new call here, whether it's 14 days, 20 days out in time. Okay? So I'm just saying that with the structure, Todd, I'm concerned about the amount of risk you're taking, even though you're proper position size, because if you pick 4 or 5 positions, buy 4 or 5 calls on 4 or 5 different stocks 30 days out, 3 of those calls go to the full loss, and 2 maybe you're able to get back into the RPM. Think about it. You took 3 full losses, 2% of your portfolio in a 30-day time period. That's 6%. Whereas if I structured and bought all 5 married puts to begin with earnings, those ones that fell, I could choose to close one of them out if I don't think there's any recovery, or restructure them for that point and continue trading them and applying the income methods if I think they're going to recover. And again, I likely paid less per day on the put than the short-term call. I know I'm not comparing apples to apples, but we already talked about why that's the case. I can also structure the married put to do something like that going into earnings so that I own the stock already, and even in this V here, this might only be a 6, 7, 8% maximum risk. And if the stock takes off, hey, I can still manipulate the position and lower my risk. If the stock falls, I might be at a profit, or I can go from there. It's using the married put and limited risk structure to create a synthetic long straddle for earnings, which brings me to my next point. Going back to our slides, for earnings season, rather than just buying the call and expecting it, even though it's an extra cost, you might want to consider the long straddle position for earnings. If it goes up as you expect, the profits that you have on the long call, though slightly muted by the extra cost for the put to give you this structure, buying the long call and the long put, you could still convert it to a married put at that point and have a lower risk than if you had just started it from the beginning. But if I started it from the beginning, I'd be able to roll the married put, cancel some of the risk, and then maybe cancel it again to be bulletproof. But this still allows you to convert if you want, but if you're wrong, you can just take the profit if it's there and not worry about trying to roll, adjust, or taking the full loss. You can see Ernie's video, the introduction to long straddles for earnings positions. It's at powerop.com/longstraddlevideo.asp. Okay, so that's my suggestion, Todd, is rather than consider just trying to do the long call hoping that it goes up, because what have we all seen? I've had stocks this last cycle that increased revenue, increased growth, but the outlook for next quarter based on costs of maybe fuel or delivery aren't looking so rosy, so it falls 15% even though with everything with a positive earnings. That's what I'm concerned about here with doing the short-term calls, hoping for just a bullish move and converting it to a married put, because 50% of the time you might hit the full loss on that long call. And you're actually taking little losses much faster than you would if you just open the long-term married put to begin with. Now, sure, if a stock like Alta drops 30%, you're going to lose almost 100% on that long call you bought 30 days out, 25 days out, and I'm going to be at near full loss on my married put position. But I can manipulate the put if I think the stock's going to recover. You don't really have that advantage. You're just going to get out of that call for 5, 10 cents and then maybe buy another call. Might be a similar looking risk-reward profile, but again, I have the choice to do that rather than seeing 100% loss. And yes, it's only 1 and 2% of your portfolio, but I think we've seen here, at least I've tried to show here, why I might prefer to even open it just as a married put with a 6-month output with earnings coming up as opposed to short-term long call, or use the straddle so that if I am wrong, I may even just take a profit on the downside. But if I'm right, I can still convert it as you were talking about with the long call position.